this webinar today is to talk about kind of the elephant in the room for all of our move up buyers right now. And what that is you want to buy a new home. And most people that are a move up buyer currently own a home, and their current mortgage rate is lower than the market right now. So that's the conundrum. So we're going to talk about how to navigate that and how to be able to buy a bigger home, because you need a bigger home, but overcome that interest rate battle that you have right now. So let's dive in. So for those that don't know who I am, so I'm Andy Burton with Waterstone Mortgage. I'm the mortgage advisor and branch manager sitting here in Woodbury, Minnesota. I have 20 years experience, 12 years here with Waterstone Mortgage. I'm going to give my team a little pat on the back that last year in the state of Minnesota, we were the number 9 loan officer. I was the number 9 loan officer as a team in the whole state out of 9,000 people that do our job. So big ups to my team for doing an amazing job on that. I live in the East Metro here in Lakeland. It's my family to the right over here. Actually, from last week, we were just in Florida for Waterstone's President's Club trip. So let's talk about why you're here today, why you're listening in, and we're gonna kind of dive into this. So I know mortgage rates aren't at the record low, but that doesn't mean that you can't buy your dream home. So the challenge is going from a low rate to a higher rate, which kind of kills some affordability as you're moving up. Inherently, you have to spend more money to buy a bigger home, and you're taking out more debt for the average person. So we're going to talk about 10 strategies to make your homeownership dream a reality. But let's start off with, where are we? Okay. Where are rates today? So we've had some volatility, as some of you may know, that tariffs have caused volatility in the financial markets, and mortgages ride that wave right with them. So at first, this is the 30-year mortgage chart over the last 12 months. The blue line is the 30-year mortgage, and it constantly trades up and down. So why is that? Because mortgages are backed by what's called mortgage-backed securities, which are in essence bonds, and bonds trade live daily, and they move with the overall financial markets. So there's been a ton of volatility here recently with rates, and we've seen kind of a spike here in the last week, but this is going to settle out, because you're seeing there's quite a big range, even just in the last 12 months for mortgage rates. We've had highs at 7.5, lows at almost 6, right? And this is just the last 6 months. We are back up to 6.25, down to 6.5. Now we've had this little bump in the last couple of days. This is what's going to be the new normal, and it has been this way for 3 years. Okay, so it's just kind of established that rates right now probably upper 6s for most people on a 30-year fixed. And it's my belief we're probably going to hang in that range, but we're going to have volatility in between. So what I wanted to show you guys is a lot of people are saying, maybe I'll wait until rates come down in order to upgrade my home. Well, this is the current forecast from the Mortgage Bankers Association of what the 30-year fixed interest rate is going to look like over the next 3 years. So what they're stating over here, this line right here, 30-year fixed, they're stating that the average rate for the entire year, they think could be somewhere around 6.5. But what you're seeing, it's really where it's ending. They're saying the rates are going to start higher over time. They might come down a little bit. Next year, they're supposed to average around 6.4 for the year. 2027, they're saying 6.4. So there's nothing saying in the current predictions, barring a severe economic downturn, that interest rates are going to drop dramatically. So if you're in your home right now and you're saying, maybe I'll wait, you might end up waiting years. The problem with that is home appreciation is still going to tick, right? In the Twin Cities, it's usually about 3 or 4%. So think about that on a $500,000 home. If you're upgrading, that home could be worth 515 grand next year, 530 grand the year after that, 545. So appreciation is kind of running away that price range for you. So you just want to make sure you're not waiting because of thinking that rates are going to come down. So, well, a big question I'm hearing about is there's some recession fears right now, and is that going to make real estate crash? So, what I wanted to pull up for you is the last 6 recessions, how has real estate performed? Well, we all know 2008, real estate values went down, but the recession was driven because of real estate. So, hence why the market went down in that time. Otherwise, all the other sessions except for 1991, uh, the average home value went down 1.9%. And if you actually look in the Twin Cities, it was flat here. This is a national chart. So the other 4 recessions, home values went up. They didn't go down during a recession. Why? Because of this next chart. On average, interest rates drop during a recession. But again, if a recession is to happen, we don't know yet if there's going to be one. The Fed might pivot and adjust rates a little bit, but I want you to see the last 3 recessions, how much did rates actually go down on a 30-year fixed mortgage rate? It was only 1% in 2020. During the recession of 08, it went down 1.1. In 2001, it went down 0.63%. So not as much as you might think. So if you're thinking they're going to drop to 3s or 4s, that would be like economic catastrophe. In order to do that, unemployment's going to have to spike probably in the 8+% range in order for rates to come down. So you might get low rates, but you also might lose your job. So be careful what you wish for on that. So, all right, next, let's talk about what the typical homeowner has an equity. Because if you're a move-up buyer, this is the conversation that we need to dig into. So as of right now, the average homeowner has 203,000 in tappable equity. It's kind of wild to hear that, right? Values have gone up so much. We're seeing the average move-up buyer that we're working with is somewhere between 175 to 200,000 in equity in their current home right now. Why? Because the average homeowner is in their home for 10 years. So 10 years ago, values have gone up dramatically. They paid down on their loans, so they have this huge amount of equity to be able to tap. Which, what do you do with that? That's the big question that I see. What do you do with all this equity when you're buying the next house? So what I want to let you know is when you have lived in your home for 2 of the last 5 years, the gains that you have on your house, meaning your sale price of when you bought it to your new sale price, minus any selling expenses, minus any improvements, that's your gain. As an individual, you can gain 250,000, or joint, you can gain 500,000. For the majority of all the clients that I'm working with, they fall within these guidelines. So that means all of the equity that's typically in your home here in the Twin Cities is going to be tax-free. So you're going to have this ability to tap this money when you're selling your old house equity and moving it to the next one. So you don't have to use that money when you're buying the next home. You could actually cash out some of that money and keep it if you want to. That's your choice. You are not required to move equity from the old house to the new house. I think that's a key thing that most people don't know. So let's talk about strategy number 1. I think this is maybe the best strategy, so I'm going to spend the most time on talking about this if you're a move-up buyer. So a big important thing to understand is the average American right now has a tremendous amount of consumer debt. So I'm going to show you a strategy on how to overcome this. So you can see in this core move-up buyer range, the average person has over $100,000 in consumer debt. So it's pretty wild to hear that. That's student loans, auto loans. That's going to be the camper, credit cards, second mortgages. You start adding that all together, you might be surprised on how much people have a large amount of debt. So I wanted to create for you a quick little case study. This is a scenario that I actually went through for someone yesterday. So when I was building this out for today, I'm like, this is perfect. Obviously, we don't need to name their name. This is a real world move up scenario where they're selling a townhouse for $375,000. Okay. They owe 175. This leaves them 175 grand in equity, and that they can use for a down payment on a new home. Right now, they have $1,750 a month in principal, interest, taxes, and insurance with an HOA. They want to buy a new 550. So your classic move up buyer, townhouse to single family home. So they have some credit card debt and some consumer debt. So we went through and looked at it. They had about 54,000 in debt. Their monthly payments on that debt was $1,425. So I wanted to show them, hey, what does it look like to move up? So on the left here is an example with a $550,000 purchase price. If they'd use all their equity and then save the rest for closing costs, a new payment at 550 was going to be about 3,081, right? Sounds a little rough, 1,750 to 3,081. So I said, hey, why don't you think about looking at this a little bit different? How about we hold back the money for that debt that you have, pay that off, and take out a little bit bigger mortgage. So it only goes up $352 a month for them to hold back all of their consumer debt. So this is the example that I showed to them. Their current debt with their mortgage and consumer debt is $3,175, and the new mortgage is $3,433. So it only costs them $250 a month to upgrade. So the assumption is they're going to go out and be a contingent buyer. They're going to ask for the seller to wait for them to sell their house, and then they're going to go under contract in a new house, put their current home on the market. They're going to sell their current home, and they're going to close on that. Sometimes it happens at like 9 a.m. the day of closing. They close on their old house and they buy the new house at like noon or 1. And then what they do is they take the equity from one closing to the next, to title company, and the title company writes them a check back for any leftover funds that they're choosing to have. So in this scenario, they wanted about 55 grand in leftover money so they could wipe out all their debt. So for them on a monthly basis, because the average consumer lives off a monthly cash flow, right? And for them, they were able to move up to this new home with a nominal change to their monthly payments. So they're super, super excited to be able to do that. So I also wanted to show them an example of, hey, what happens if rates drop 1%? I just showed you how volatile rates are right now, and we are popping our clients that did lock at higher rates. And when the market comes back down, we're capitalizing and locking them. So for them, if rates drop and we're able to get them a refinance, no one knows, right? But if we're able to drop them 1%, when the market cycles around, it would save them about $285 a month in the future. So fingers crossed that that happens. No guarantees, but then in essence, their monthly payments would be at a wash. This is a really common scenario that I'm seeing with move up buyers right now, that they're cleaning up debt in order to minimize their monthly payments. So if that speaks to you, or you have any more questions on that, I'd love to be able to answer that for you. So here's the next example. We see this a lot in new construction. It's using what's called a temporary buy down. So a temporary buy down is where you reduce interest rates over the first couple of years, and has to be paid for by the seller. And here's a really good example of it. So, and if you have a scenario that you would like us to run this for, I'd be happy to do it. So I created a temporary buy down example on a $550,000 buyer. They're putting 10% down. They had a rate at 7 1/8. The way a buy down works, we'll go to this middle one. If it's a 2-1, it means they can actually have the seller pay to reduce their rate to here. It's actually saves them $639 a month for the first year. Then they go into the second year at 6 1/8, which saves them $327 a month. Then payment number 25, they would go back to the locked in interest rate you have. You might say, well, Andy, why would I want to do this? Because this is one of the few ways a seller can actually just blatantly give you money, basically. So for this example, it was about 11 grand that they would negotiate from the seller. The seller would credit them that money in a contract as a closing cost credit, and it would build in a little buffer. Here's another cool thing. If rates come down, they're able to refinance, and any money left in what's called the subsidy account actually pays into the balance of their mortgage. It's super, super cool. I would say in the last 6 months, we've refinanced at least a dozen clients that looked at using this buy down the year before, and it only took them 1 year, and we were already refinancing them back down to a lower rate. And the money that was left over from this buy down over here actually paid for most of their refinance. So it's super cool. This is a really amazing strategy. And it's a seller paid buy down. You can go to these big ones up here. It's a 3-2-1 buy down. We traditionally only see 3-2-1 buy downs in scenarios where houses have been on the market a long time. So the seller's really willing to negotiate, or new construction. Builders will have financing incentives to move product. They'll sell the house for less. So they'll lower their margins, what they're going to make just to move product sometimes. And one way that you can negotiate with them is a buy down. Instead of a lower price, you say, hey, I would like a buy down instead. We just closed one of these about 45 days ago for a new construction, and it was actually in a higher price range than this. This example, they're saving quite a bit for each of the first couple of years, being able to go all the way as low as, for this example, 4125. You can do this on conventional loans. You can do it in government like FHA, VA, USDA. It's a huge common product, especially when the market slows at certain times of year and you have an ability to be able to negotiate. So next, let's talk a little bit about if you should maybe consider a lower price range. So that's what I'm seeing. Some clients that they're deciding that they're outgrowing their home. They're in a townhome right now. Maybe they're not going to go right to that dream home stage. Maybe they actually have to readjust their budget. And maybe they should be looking at just a step down in price in the near term here, versus going for the big house right away, because the family has expanded. They've had their second or third child. They just need a little room. They need a backyard for the kids to run around in. So I know this might seem obvious, but you just might need to recalibrate what it is that you're going to be looking at for your next home, and it may not be as expensive as you originally thought. So if you're considering a larger down payment, I wanted to give you a quick example on this. If you put 10 grand more down on a 30-year mortgage at a 6.6, it's 64 bucks a month. So if you wanted to go ahead and put 100 grand down more, it only lowers your payment 640 bucks a month. So of course, if you happen to have a huge pile of money that you want to put down to lower your payment, that's great. Now, the younger you are, the less I advise towards this. The reason is you could be investing that money over the long term. But every scenario is different. So what most people are surprised on is they would have thought that adding an extra 10 or 20 grand would have dropped their payment a lot more than it really does. So let's talk about government programs. You might say to yourself, well, what does the government program have to do with it? Well, government loans right now are significantly lower than conventional loans. Like the average VA loan is about 0.625% below market rate. So government loans also are not just for first-time home buyers. And some of the benefits of that, when we're talking about harvesting equity, we've recently had some clients, but they've literally sold their house, harvested all of the equity, and kept it. And in turn, they use the government product, which allows less money down and gives you a little bit better rate to be able to buy their next home. I can think of specifically, I had a client who had over 100 grand in equity, and they sold their house, paid off every single debt that they had, including student loans, and they bought with a VA loan, 100% financing, and their monthly payments went down. So for them, it was a huge win on looking at options. So and VA loans from a few years ago, they were 1% of the overall market. I just saw a stat, 13% of all loans are VA loans right now. So these are amazing loan products to be able to look into if you're educated and you understand how they work. So if I have some clients come in and say, I want to buy a house on a 15-year mortgage only, I'm only looking at a Dave Ramsey plan. Once we start looking at options for them, it's not uncommon that they set their budget on a 15 or 20, and then they say, you know what? I'm probably gonna have to go back to a 30-year loan if I want to keep this affordable and to be able to get the upgrade that I really want. I think for the average person, if you're under the age of 50, probably shouldn't be in a shorter term mortgage. You should be more focused on investing your money, having a limited amount of equity in your home, so you can have compounding on both, compounding on your home value, compounding in the stock market, because this current stock market correction is going to pass us like every other one has. So let's talk about buying down your rate. This is a common question that I get. So it's like, Andy, I would like to pay upfront points to get a lower rate. Again, where do we see this? Builders will do this to drive their interest rates down on their product, and all that they do is build it into the price. So I'm not a huge fan of paying a lot of discount points. So in the middle, I gave you an example. This is the same borrower they were kind of going over for examples at the 550 with 20% down. If they were to pay 4 points, which is 4% of their loan amount, they would save $285 a month. The problem is the cost. The cost of this example is $17,600. So I'm not as big of a fan of this. Maybe if you want to pay a point or a point and a half, I usually am not a fan of going much higher than that. So the reason is save your money and put that money in a rainy day fund. And if the market were to drop significantly, apply that money towards the cost of a refinance versus just paying it up front, because the market's probably going to cycle up and down right now. So you could pay all these points up front and the rates may go lower than what you even bought it down to. So just to recap, 4% of your loan amount will drop your rate 1% on average. Not a super smart move to do, but is it a strategy? Yes, it is. So next, if you're looking at up and coming neighborhoods, so look at places outside of the prime markets. So right now I'm officed in Woodbury. So a lot of people in the East Metro, or if they move to the area immediately, they say they want to move right to Woodbury, right? Which is like the most expensive area in the East Metro. So for them, they might be better off to look at surrounding communities where the price drops significantly. So, but these other surrounding communities are probably more likely to appreciate quicker because you're not alone. People start looking at the more expensive community and then they downshift and they look at the less expensive surrounding community. So if you pay attention to that, East Metro will have people that will start in the East Metro, and all of a sudden they're going significantly more rural. They're willing to drive to buy a more affordable home. So just expand your options on that. So you obviously have to take into consideration drive time and cost for gas. So, all right, we're seeing a lot of people that are looking at, can I get a second unit to either have a family member for multi-generational living, or they are looking to try to rent it out. We just closed one last week where there was a basement in the basement. It had a full kitchen and they were going to have a friend live there for pretty reasonable amount on rent. They thought they'd get up to $1,000 a month in rent to help offset their mortgage payment. So this is a common thing that we're seeing, multi-generational, getting more and more common for people to be able to have a grandparent or parent live in the house with them. They have shared resources for down payment. They'll even chip in on the monthly payment. So if that is something that is of interest to you, let me know, because we can look at what's special on a credit application for that as well. So, and depending on the product, you can actually take into consideration rent of an actual multi-unit from the other units for the primary. That's a super, super smart strategy. So let's kind of recap here and talk about that. Yes, you can buy homes in a high rate environment. Yes, we are getting a lot of credit applications. Our credit applications are up considerably over this time last year because people are getting sick of waiting. They've been waiting 3 years for rates to come down. And in that same period of time, home prices have gone up 7 to 10% for them. They thought that prices were going to stagnate, and they're not. So if any of this speaks to you and you have any questions, I'd love to be able to help. And if you're ready, you can reach out to me individually, and I'd love to be able to give you a one-on-one consultation. of what it's going to look like to buy your next house. So